Imagine sitting at your kitchen table on a quiet Tuesday afternoon. The kettle is just starting to whistle, and you've got a fresh packet of milk arrowroots ready. You open a letter from Centrelink that arrived in the Morning Post. You gave your daughter $10,000 last Christmas to help her with a deposit for a modest unit in Geelong. It was your money. You worked 40 years for it. You paid your tax. But as you read the letter, you feel a knot in your stomach. Your age pension payment has been cut by $78.30 every single fortnight. Over a year, that is more than $2,000 gone. You didn't hide the money. You didn't spend it on a luxury cruise. You helped your own flesh and blood. And yet, because of a rule that hasn't been updated since the year 2002, you are being penalized as if you still have that cash sitting in your bank account. This is the reality of the $10,000 gifting rule in 2026, and today I am going to show you exactly why this situation has quietly gone from a minor nuisance to a major financial trap for thousands of Australian families. G'day Australia, I'm James Walker, and welcome back to AUSPENSIONGUIDE. It is wonderful to have your company again. I spent many years on the other side of the desk as a pension advisor, seeing firsthand how confusing the system can be. Now, I work for you. My goal is to make sure you have the clear answers and the real numbers you need to navigate Services Australia without the stress or the jargon. By the time we finish today, you are going to understand the hidden math behind the gifting rules, the upcoming Deeming Cliff that is going to make these penalties even more expensive, and most importantly, the 3 legal ways you can still support your family without losing your own financial security. You've worked hard, you've contributed to this country, and you deserve to know exactly how to keep what is yours. If this channel has helped you or perhaps helped your parents feel a bit more confident about their retirement, do me a small favor. Hit that subscribe button just below the video and tap the little bell icon. It doesn't cost a cent, but it ensures you get my weekly pension updates the moment they drop. We're building a real community here of seniors who look out for one another, and I'd love for you to be a part of it. Now, we need to talk about the big picture. We are living in a very different Australia than we were 2 decades ago. According to the latest data from the Australian Bureau of Statistics, the cost of living has soared, yet the rules governing how you can spend your own money have stayed frozen in time. Back in July of 2002, when the current $10,000 gifting limit was set, you could buy a brand new Toyota Corolla for about $19,000. Today, that same car will set you back $35,000 or more. $10,000 in 2002 had the purchasing power of nearly $18,000 in today's money. By keeping the limit at $10,000 for 24 years, the government has effectively cut your ability to help your children by almost half. It is a stealth tax on your generosity. There are over 2.6 million Australians on the age pension right now, and about 40% of you are on a part pension. For that group, every dollar counts, and these gifting rules are the #1 reason I see people getting hit with unexpected debts or payment reductions. Now here is the first thing I want you to understand, and it is the part that causes the most confusion. Services Australia calls this the Deprivation rule. It sounds like something out of a Victorian-era novel, doesn't it? But essentially, it means that if you give away more than $10,000 in a single financial year or more than $30,000 over a rolling 5-year period, Centrelink treats the excess money as if it is still yours. They call this a phantom asset. Let's look at a real-world example so you can see how this works in practice. Take Barry, who is 71 and lives in a lovely part of Rockhampton. Barry is a homeowner, and he's on a part pension. He wanted to help his grandson, Liam, buy a reliable ute for work. So Barry gave him $15,000. Barry thought, well, I'm $5,000 over the limit, so what? But here is the sting. For the next 5 years, Centrelink will continue to count that $5,000 as part of Barry's assets. Even though that money is now a white ute driving around central Queensland, for Barry's pension calculation, it's still sitting in his NAB savings account. But it gets worse than that. Not only do they count the $5,000 as an asset, they also deem it to be earning income. Right now, the higher deeming rate is 2.25%. So, Centrelink assumes Barry is earning interest on money he no longer has. This reduces his pension income test and his asset test simultaneously. Now, we've been lucky lately because the government froze those deeming rates during the cost of living crisis, but that freeze is scheduled to end on the 30th of June, 2025. When we head into 2026, those rates are expected to climb. If the deeming rate jumps to 4 or 5% to match the commercial world, the penalty Barry pays for helping his grandson is going to double. This is why I say the rule just got worse. The limit stayed the same, but the cost of breaking it is about to skyrocket. You might be wondering, what actually counts as a gift? Most people think it's just writing a check or transferring cash, but the net is much wider than that. I remember a lovely couple from Bendigo. Let's call them John and Glenda. They decided to sell their old caravan to their daughter for $5,000. The caravan was actually worth $15,000 on the open market. They thought they were being helpful. But when Centrelink found out, they marked down a $10,000 gift against John and Glenda. Why? Because the market value was higher than the sale price. That $10,000 difference is considered a gift. This applies to cars, property, and even shares. If you sell the family home to your kids for mates rates, you could accidentally trigger a deprivation rule that wipes out your pension entirely for 5 years. It is a heartbreaking mistake that I see far too often. Now, pay attention to this part, because it's where you can actually use the calendar to your advantage. The $10,000 limit is based on the financial year, which runs from the 1st of July to the 30th of June. This creates a very specific window of opportunity that I call the June-July split. If you have $20,000 that you really need to give to a family member, perhaps for an emergency or a specific milestone, you don't have to give it all at once. If you give $10,000 on the 20th of June and then give the second $10,000 on the 2nd of July, you have technically stayed within the $10,000 per financial year limit. However, and this is a big however, you must remember the second half of the rule, the $30,000 limit over 5 years. If you use the June-July split, you've used up $20,000 of your $30,000 bucket in just 2 weeks. That means for the next 4 years, you can only gift another $10,000 total before the penalties kick in. I've seen people get the first part right, but then forget the 5-year rolling window, and they end up with a phantom asset that lasts half a decade. It's like a shadow that follows your pension around, and it is very hard to shake off once it's there. If you're finding this breakdown helpful, please drop a quick comment below. Even if you just type "thank you" or "cheers James," it really helps the YouTube algorithm realize that this is important information for Australian seniors. It helps me reach more people who might be sitting at their own kitchen tables right now, worried about these very same letters. Let's talk about the why behind this. Why is the government so strict about this? From their perspective, they want to prevent people from dumping assets just to qualify for a higher pension. They want to ensure the age pension goes to those who truly have limited means, but I reckon they've missed the mark by not indexing these figures. When the age pension maximum rate increases twice a year in March and September, which it does to keep up with inflation, it seems only fair that the gifting limits should increase too. In March 2026, we expect the single pension rate to be around $1,180 per fortnight, including supplements. As those rates go up, the relative impact of the gifting penalty feels even more lopsided. I want to tell you about Margaret. Margaret is 76, lives in a quiet street in Ballarat, and she is one of the sharpest people I know. She wanted to give her son $50,000 to help him through a difficult divorce. She knew about the $10,000 rule, but she said to me, "James, it's my money, and he's my son. I'll just take the hit." We sat down and did the math. Because Margaret was already quite close to the asset test threshold for a single homeowner, which in early 2026 will be sitting around $310,000, that extra $40,000 of phantom assets, the $50,000 gift minus the $10,000 free area, was going to reduce her pension by $120 every fortnight for 5 years. That is $15,000 $600 in lost pension payments over 5 years. I asked her, Margaret, can you afford to give your son $50,000 and then give the government another $15,000 on top of that? When we put it that way, she realized she needed a different strategy. One of the most important things you can do is keep a gifting diary. I know it sounds like more paperwork, and believe me, I know you've done enough paperwork to last a lifetime. But if you have a simple notebook where you record the date, the amount, the person you gave it to, and the reason, it makes your life so much easier when you have to deal with Services Australia. You are required by law to notify Centrelink of any change in your circumstances, including gifts, within 14 days. If you wait until your annual review, they might backdate the reduction, leaving you with a large debt that they will recover by docking your future payments even further. Look, I know this can feel overwhelming. The rules seem designed to trip you up, and the phone hold times at Centrelink are enough to test the patience of a saint. But you aren't alone in this. Thousands of Aussies are navigating this every day. The key is to be proactive rather than reactive. Don't wait for the letter to arrive. Understand the math before you move the money. Here is exactly what I want you to do this week if you are thinking about gifting money, or if you have already done so. I've put together a 5-step action checklist to keep you in the clear. First, check your total gifts for the last 5 years. Go back through your bank statements or your diary. If you are approaching that $30,000 total, you need to stop and wait until the older gifts fall off the 5-year window. The clock starts from the date of the gift, not the end of the financial year. Second, call the Financial Information Service, or FIS. This is a free service provided by Centrelink. You can reach them by calling the main Older Australians line on 132300 and saying Financial Information Service when the automated voice asks what you're calling about. These officers don't handle your specific claim, but they can give you expert information on how a gift will affect your specific numbers. It is a brilliant service that most people don't use enough. Third, if you have made a gift, log into your MyGov account and update your assets. It is much better to have a small reduction now than a huge debt in 12 months' time. If you aren't comfortable with MyGov, you can visit a service center in person. Whether you're in Newcastle, Geelong, or a small town in the Wheat Belt, the staff are there to help you record these changes. Fourth, document everything. If you are giving money as a loan rather than a gift, make sure there is a written agreement. A loan is treated differently than a gift, but be careful. If you later decide the person doesn't have to pay you back, that forgiveness of debt becomes a gift on that day. Fifth, review your overall asset levels. If you are well below the asset test threshold, for example, if you are a couple who owns your home and your total assets are only $200,000, then gifting $15,000 won't actually change your pension rate because you're still under the free area for assets. The $10,000 rule still applies, but it might not actually cost you any money. It's the people on the taper rate, the ones on a part pension, who need to be the most careful. I want to take a moment to say something very important to you. Sometimes people feel a bit of shame or embarrassment about having to worry about these rules. They feel like they're asking for a handout. I want you to put that thought right out of your mind. You have worked your whole life for this country. You've paid your taxes, you've raised your families, you've volunteered in your communities, and you've built the Australia we live in today. The age pension isn't charity. It is a pillar of our social contract. It is what you have earned through decades of contribution. Claiming your full entitlement and protecting your pension is your right, and you should never let anyone or any complicated government form make you feel small for doing so. Now, of course, every situation is different. What I've shared with you today is general information based on the 2026 projected rates and the current Social Security Act. It isn't personal financial advice, because your bank balance, your home ownership status, and your relationship status all change the math. You should always speak with a professional or a FIS officer before making a big move. If you found value in our chat today, please hit that like button. It really does help the channel. And if you know someone, perhaps a friend at the RSL, or someone in your walking group who is thinking about helping their kids with money, please share this video with them. You might just save them from a very expensive 5-year mistake. Next week, I'm going to be looking at the new rules for the Commonwealth Seniors Health Card and how the higher income limits in 2026 are opening the door for thousands of self-funded retirees to finally get cheaper medicines and power bill relief. You won't want to miss that one. This is James Walker from AUSPENSIONGUIDE. You've earned this, Australia. Take good care of yourselves, keep the kettle on, and I'll see you in the next one.